All right. We're going to get started today. We're talking about paying yourself as an owner. So, for those of you that are going to hop on live here, or maybe you're watching the recording on your time, we are focused on helping you understand how to pay yourself as an owner when you own your business. And ultimately, today, I want to help you accomplish salary distributions and peace of mind. My name's Nate Goodman. If you're in the community, you've probably met me. If not, feel free to schedule some time with me. I'd love to get to know you more and understand more about your practice and how you guys are growing. And I hope this today is helpful information to help you have some peace of mind and also accomplish some tax savings and your goals for your practice. So, one thing I've been thinking through when I think about paying yourself and when I started paying my own self through my business was definitely something that was confusing at first. If you're still paying yourself whatever is left, so if you look at the bank account after all your expenses, you don't have a system. You just have anxiety. And so every week that you go through, your home has bills, and we're trying to figure out, can your home sustain the bills that you have? And so then you go to work and you're seeing patients and trying to market your business and trying to, get new patients in the door. And you're sitting there thinking, well, what's going to happen if I can't pay myself and take care of my own bills? And so a lot of people, when they don't have a system in place, they take on a lot of extra jobs outside of the practice, and just so they can have that peace of mind knowing that they can pay themselves without ever thinking through a budget or a system of how they could have paid themselves. And it ultimately leads to lack of focus on the business, and we're not able to grow and build the business that we want to have. So today, what I want you to be able to leave with are these three things. And we're going to talk through each one. But the first is owner's pay. That's compliant and optimized. So depending on your entity structure, you have to pay yourself a certain way. And we want to have a number that you're paying yourself that you could defend to the IRS and feel good about taking home. Number two is the line between business profit and personal income, and why what the practice earns is not the same as what you pay yourself. And number three is income smooth enough to plan life around. We want to be able to take out money in a regular cadence and not have this boom or bust mentality where we're living life really well and have a lot of personal life scope creep. And then the next month we don't have as much. And so we're scrambling to figure out what to do. We have a system that allows us to have predictable take home pay. We're able to have a much smoother operation, make decisions not out of fear, but out of certainty. And so we'll talk about how we can have income that's smooth enough to plan your life around. So let's talk about number one. Before we start talking about your pay, we have to understand what that your own profit in your business is not your personal income. Some people get this right out of the bat, and some people, this is a hard concept to understand. And so when we talk about profit in your business, you have to think about, even if you're not an S corporation or a C corporation and you've just got an LLC set up, it's really easy to think that all the money that the business is making should be my personal income that I take home. And again, that mentality takes us right back to the point of where you're taking whatever's left, thinking about the profit in the end. Whereas if we plan, hey, this is how much I'm going to be paying myself, I need to budget all my other expenses accordingly, we don't run into that problem. Every dollar belongs to one of four cash flows. So you're going to have cash flow coming in, which is your revenue. That's the practice brings in. It's the top of the funnel. That is not your paycheck. What the member pays for your business is not what you pay yourself. Most people get that. They're not taking out every dollar that comes in the top. The flow number two is operating expenses. This is flow going out of the business. So that's your rent, your staff, your supplies, your software. It's the cost of keeping your doors open. Flow number three is paying yourself. This is what you take home. It's planned, it's consistent, and it's not whatever's left. And then flow number four is tax savings. We need to make sure we're also setting aside money into taxes before it feels like it's yours, so that April, whenever tax season rolls around, it's not an event. It's just something we've already got set aside. We know it's coming. The money's ready for it. When we separate out those four flows of cash that are coming into the business, it helps us start to understand a little bit more about the money in our business and how we can use it to help ourselves and help our business and help our community. So you have those four cash flow drivers that are affecting your cash on hand. Now, we do have three numbers and kind of three different questions that those numbers ask. The first one is revenue. So like we said, this is the bright top line. It's the vanity number. How many patients do you have in your panel? What's your total revenue of your practice? Um, it does tell you and answer the question of how busy you are. And so unless you don't have a good pricing model, typically the more money you have and are making, the more busy you're going to be as a business owner. Profit, so the bottom line on your profit and loss statement is how healthy you are. This is what's left after the real cost of running the practice, and the numbers in that is what drive pay. The last one is cash flow, and this is answering the question of, are you safe right now? Do you have enough money to actually pay all the bills, pay yourself, keep things afloat, and sleep at night? So a lot of people look at just the bank account, but they're not looking at, what's the actual amount that the cash went up or down month over month instead of like on a daily basis. One big trap here is, and this is where most people get confused about accounting, is that on your profit and loss statement, you can be profitable on paper and still run out of cash because you have loan payments, you have draws for the owner, all of that's pulling cash out, but that doesn't show up on the P&L. And so when that happens, it is affecting the cash on hand. And so we have to be careful that we don't just look at the profit and loss numbers. So let's look at, what does it take to actually build a defensible salary? It's not a guess. It's not a colleague's number, what they're paying themselves. Each salary inside of a business, especially we're going to talk specifically about S-Corp owners compensation. It's built from the work that you actually do. So it's unique to each doctor that we work with or each owner that we work with. And so we do this through these kind of three roles ideas. So when we set pay for people, we ask them a couple things. Number one, you have clinical roles, right? You are the physician, you're the highest paid employee at the company when you are the doctor in the room. This would be benchmarked against any physician level salary in your area for like a primary care family office, not like the big hospital systems or something like that. It has to be relevant to the specific job that you're doing. The next is typically operational. I wouldn't call it, I have it in here as COO or as operations manager. That operations role has a lot of low level administrative work. So if you're answering the phones, if you're doing marketing, if you're sending, emails every week and you're doing phone calls, all of that is administrative, low level secretarial work. And you can pay yourself a lot less for those hours that you do that work. The third role is leadership. And this is where you're doing vision, growth, culture. You're thinking about the future of the business. Maybe you go on a planning retreat, or you take a certain amount of time each week just to look at, okay, where do I want to be in the company a year from now, 2 years from now? That work is what sets the practice's direction. So once we see kind of these three buckets of time spent, your reasonable compensation should reflect the totality of these roles, not just being a doctor. So uh, it's okay. Like I think a lot of people use take-home pay as a like a vanity metric too. Oh, I take out this much money out of the business, or I used to make this at my prior role, so that's what I want to make here. And they confuse W-2 salary, what you have on payroll, for taking owner's distributions out of the business. So we don't need to inflate it. We just need to pay you the reality of what you actually do for the business. And by doing so, you can actually save a considerable amount of money on self-employment taxes for doing this correctly. Reasonable compensation, I say this, reasonable compensation demystified. Um, what is it? What it isn't? A lot of people, if they talk to their CPA, will say you should just take 60% of whatever your business makes and take that as an owner's salary, and then take the other 40% as just a distribution to yourself. You can write yourself a check. Other people say, well, let me just use what my colleague uses, right, at another family office or family practice. And other people say, well, just we'll do whatever it takes to keep the taxes the lowest. So I'll pay myself $40,000. That also doesn't count. So those are not good benchmarks of how you would set your salary. What it is the IRS's standard is for reasonable pay, is for the time you spend in the roles that you hold. Typically, when we see this for owners, it's a blended role calculation. And we can then get a defensible figure with compensation study tools. There's a tool called RC reports that you could use. And then you just take a survey and say, I spend 20% of my time doing secretarial work. I spend 20% of my time doing marketing, 20% of my time doing finance. And I spend, 40, 30% doing actual clinical physician work. It's also helpful to know, like, are you doing nurse work when you're taking vitals? Are you doing drawing blood and doing phlebotomist work? That all shifts what you get paid. And the RC report is a really helpful tool. You could also use Claude or ChatGPT now to try to document some of this, but you want to make sure that you back it up with data from the area. And then the other thing that we need to do is revisit it and update it every single year, because the time you spend on the business as your business grows shifts and morphs as you hire people and put people in different seats. So let's look at a salary to try to like take this, philosophical idea and to put it into action. So we've got an S corporation, uh, and you have a W-2. The W-2 salary that you pay yourself, that's using Gusto, Paychex, ADP, any of those payroll providers, whatever is listed as your salary in there, you're going to pay 15.3% uh, Social Security, Medicare for both the employee and the employer. If you are not an S corporation, all of your net income is this 15.3% self employment tax. And you also have to pay income taxes on top of that. When you take a distribution from your company, so if you just cut yourself a check and transfer it from one bank account to the other, that's a distribution. And it flows through and does not trigger self employment taxes if you are an S corporation. So let's assume that there's $250,000 in profit and we split it into a defensible salary plus distributions. We could save around $16,000 in payroll type taxes versus paying it all as a salary. Um, so profit, you can see here on the left, if we took an $80,000 salary, we were able to justify it with the time spent, and then our distributions of 170 are going to help us get to that number. Um, so then the next piece is timing matters more than the entity. So electing S Corp too early, while revenue is still inconsistent, is going to add additional costs. So you have to pay for a payroll software. I don't recommend doing it yourself. That's going to add also an extra $1,500 to $2,000 a year for tax return preparation. And as long as profit can support it, the election for S Corp is a tool that allows you to reduce taxes, but you don't need to do it before you hit. We typically say between $80,000 and $100,000 in net profit. So a case study: Dr. F elected early. They found the complexity outweighed the savings, and they had wanted to revert. Once they were actually profitable, they could re-elect. But we typically just recommend not having to go that route because that's costly. If you're like wanting to revoke an S election to get it to work, why don't we just wait until it actually works? So let's talk about smoothing income for peace of mind and how to do this with your business as it grows. So a compliant number only helps arrive at predictability, but this is really where your system meets your kitchen table, right? Where you're trying to put food on the table, trying to bring home the bacon. Uh, the smoothing of income helps you build a budget. So I usually typically recommend, just to give people some clarity that are not accountants, to do a 3 account system. It's very similar to the profit first model. We pull off some of those same ideas. We would have an operating account That's where all the subscription revenue goes into, all of your bills come out of. We have an owner's pay account, and then we have a tax account. Each is in its own place and doesn't get blended between the two. Don't start paying stuff out of one. And then I typically recommend use the same bank so you can intertransfer really easily. We want to build a 12-month cash flow forecast so we can see what low cash months are coming and plan, not panic. When you do that, you can say, hey, if I hire this person, for as long as everything goes to plan and I bring on 10 patients per month, I'm going to get down to $10,000 in this month of August. I can still pay myself, still pay my employee, but it's going to feel a little shaky because I'm getting low. But as soon as that month is over, if I keep going on my plan, 10 a month, then I'll be okay. What that does then too is you can now take a consistent and planned paycheck. It's set apart from operating expenses. It's paid on a schedule. If you put all that money into your owner's pay account, you have the money set aside to pay yourself. Another a study for you guys. Dr. G underpaid out of fear. There's a low salary, made home income unpredictable. That obviously led to anxiety. Adjusting pay to reality and putting it on a schedule brought that relief and allowed them to continue to focus on the business. So, in closing, financial clarity is here to protect the mission. We're trying to help DPC owners build thriving and successful practices. That way, they can support the lifestyle and live the way that they want to live and enjoy the passions that they have outside of running their business. And so, building in these budgets and building in the ability to pay yourself consistently and on a system. Next is you're able to keep profit and it keeps pay distinct so you know when your business is healthy, but also that your home is healthy. And then make it smooth. Have a predictable amount that you take out on a monthly basis to hit your budget. If you want to pressure test your own numbers inside the circle, feel free to shoot me a message. I'm happy to help you pressure test those. If you are in the circle, we can help. You can schedule a time with us to go over those one on one. Thank you guys so much for joining. I know this was a short one, but I hope it packed a punch with what's needed for where your practice is right now. If you have any questions, we're here to help. Would love to answer questions for you, get support within the community, and see you guys continue to grow and thrive.